Silver didn't dip, silver got cut. In a few hours, the metal that looked untouchable, fresh off a record sprint, dropped hard enough to make even seasoned traders go quiet. A 7% crash in hours isn't a normal pullback. It's a forced behavior event. And if you don't understand what just happened at year-end, you're going to misread the next move, because the same mechanics that created the bloodbath can create the snapback. You saw a violent red candle, maybe multiple, maybe the kind of wick that feels personal. But the real event wasn't silver decided to go down. The real event was this: year-end conditions, plus crowded positioning, plus higher margin costs, plus thin liquidity, forced selling. That's the formula, and we just watched it run at full speed. Financial Times described the drop as a sharp reversal after a record-breaking rally, with profit-taking and a CME notice about higher margin requirements, helping drive forced reductions. Reuters also reported the surge to record highs and then the abrupt giveback, with thin holiday liquidity magnifying the move and the rebound. People were winning. Risk desks changed the rules. Liquidity was thin. The crowd tried to exit through the same door. That door was not wide enough. Year-end is a weird season. Not because the fundamentals change overnight, but because behavior changes overnight. Funds close books, traders reduce risk, dealers manage inventory. Margin becomes a bigger deal, and liquidity gets thinner than it should be. So when the market is crowded and emotional, year-end turns a normal correction into a cliff. Think of it like this: in a crowded cinema, you can bump someone and it's fine. In a crowded cinema where someone yelled, "Fire," a bump becomes a stampede. Silver didn't just fall. Silver hit stampede conditions. Here's a detail most people skip, and it matters. When exchanges raise margin requirements, the cost of holding a leveraged position jumps immediately. That doesn't mean everyone sells because they changed their mind. It means some people sell because they don't have a choice. Financial Times tied the sharp reversal to profit-taking and higher margin requirements for metal futures. This is why moves like this feel unfair, because they're not fully psychological, they're mechanical. It's a forced deleveraging event, and forced events don't stop at fair value. They stop when enough people are out of the trade. That's why you get the ugly candle. That's why you get the sudden air pocket. That's why you get panic. Why 7% in hours is a message. A 7% crash in hours tells you three things. Silver has become a leverage playground. When a market gets popular, it gets crowded. When it gets crowded, it becomes fragile. Liquidity is not your friend in stress. When conditions are thin, the market moves like a wild animal. There's a difference between price and exit price. You can see a quote on a screen, but in a fast flush, you learn what you can actually get filled at. And yes, this also means the bounce matters, because the rebound is the market asking, was this liquidation or was this a trend break? Reuters described the slump and subsequent stabilization rebound in thin holiday conditions after extreme volatility. So we're not here to stare at the blood, we're here to understand whether the bleeding created fuel. The bloodbath stack, 6 layers that hit at once. Let's stack the layers. Layer 1. The rally was extreme. Reuters noted the metal's explosive year and fresh highs before the sharp pullback. Layer 2. Profit-taking. When something runs that hard, people take money off the table. That's normal. Layer 3. Margin changes. When margin rises, normal profit-taking becomes forced selling. Layer 4. Thin liquidity. Year-end markets are notorious for weird wicks and exaggerated moves. Layer 5. Momentum traders get trapped. When the trend breaks, momentum flips from buying to dumping. Layer 6. The headlines turn fear into acceleration. A big drop becomes a narrative. A narrative becomes more selling. This is how you get a 7% event in hours, not one cause. A stack. When you see a violent reversal, the internet immediately screams, "It was a bubble." Sometimes that's true, sometimes it's lazy, sometimes it's both. MarketWatch highlighted SocGen's model flagging bubble-like behavior, while also noting analysts' warning that structural forces may be distorting the signal. And that's the honest situation. There are reasons to be cautious, and reasons to be careful dismissing it as just a bubble. The only sane response is this: stop worshipping labels. Start watching behavior. Because bubble or not, the mechanics of a year-end flush are real. Let's walk through what can happen behind the scenes. Step A. Price rises fast, people pile in, leverage increases. Step B, volatility spikes, risk desks tighten. Some traders get warnings. Step C, margin requirements rise. Now the cost to hold the position is higher. Step D, some accounts can't post additional margin fast enough. They reduce, they sell. Step E, selling hits thin order books, slippage gets nasty. Step F, stops trigger, liquidations trigger, more selling triggers. Step G, the move overshoots, then the market stabilizes, then you see a rebound. This is why in a flush, support levels can look like they don't exist. They exist, but they're not strong enough to absorb forced flow. What it means if you're a trader. If you trade, I want you to tattoo this idea in your mind. In a forced market, tight stops are donations. Not because you're wrong, because you're in the wrong environment. When liquidity is thin and wicks are violent, the market can hit your stop, reverse, and continue the trend without you. So what should you watch instead? Recovery behavior. Does it bounce sharply or bleed slowly? The second push. Does it attempt a new high quickly or fail? The no perfect entry effect. Do dips get bought instantly? Overnight action. Thin hours reveal urgency. Reuters described the rebound after the plunge and the market's attempt to stabilize. That rebound is not proof, but it is information. What it means if you're a holder. If you're holding long term, here's the brutal truth. The chart is not your enemy. Your enemy is emotional decision-making during forced events. A year-end flush is designed by nature to create two mistakes: panic selling at the worst moment, revenge buying at the worst moment. So your job is simple. You don't predict. You watch structure. Ask, did anything fundamental change? Or did behavior change? In a year-end stampede, behavior changes first. And yes, if the physical market stays tight while paper washes out, that's a different story. But today's topic is the crash. We're explaining why it happened and what it tells you about the regime. Why this can happen even in a bull market. Here's a trap people fall into. They think, if it's bullish, it shouldn't crash. Wrong. Bull markets crash all the time. They crash because bull markets attract leverage. And leverage turns corrections into cliffs. So a crash doesn't automatically mean the bull market ended. It means the bull market got crowded. Bloomberg described the rally halting and metals plunging as profit-taking and risk controls hit. Here's the checklist you can use anytime you see a violent drop into year-end. Was liquidity thin? Holiday low volumes? Was the move preceded by a parabolic run? Did margin requirements rise or risk rules tighten? Did the drop happen fast? Hours? Suggesting forced flow? Did it overshoot and then rebound, suggesting liquidation then stabilization? Did headlines shift from moon to crash instantly, accelerating fear? If most of these are yes, you're probably not watching a new fundamental truth. You're watching a mechanical reset. The three possible next moves. Now let's talk about what comes after a flush like this. There are three broad paths. Path A, dead cat bounce, a relief bounce, then lower highs, then slow bleed. This happens when the rally truly broke. Path B, bear trap. The crash convinces shorts the coast is clear. Then price reclaims key zones quickly and squeezes them. This happens when the flush cleared leverage, but demand is still there. Path C, range reset. The market chops sideways while everyone calms down and repositions. You don't guess which path it is. You watch the reclaim behavior. Does silver regain the damage zone quickly, or does it struggle every step? Reuters described a rebound after the plunge, but the question is whether that rebound holds. That's the game now. Let me tell you a quick story that every trader learns the hard way. There's a moment in every mania where people stop asking, is this healthy? And they start asking, Doc, how do I get more? That's when leverage sneaks in. That's when risk gets ignored. That's when the crowd becomes one animal. And then one day, the animal hits a wall, margin, liquidity, or a rule change. And suddenly the market teaches everyone the same lesson at once. That's what a 7% crash is. It's a group lesson. It doesn't ask permission. It doesn't care about your conviction. It just clears the room. What you should do right now. Here's what I want you to do. No drama, no hero mode. Zoom out. One day doesn't define the trend. Identify whether the drop was forced. Use the checklist. Watch the recovery behavior over the next sessions. Not the price, the behavior. Respect volatility like it's a weapon, because in a market like this, it is.